Are we live? I think we're live on Facebook. We're live on Instagram. And I think, oh, look at there. There I am on YouTube. I am going to mute you. Nice. All right. Here we go. Brandi Jo live on Saturday morning. Sweetness. Okay. What are we going to talk about? We're going to talk about the 5 points email that I sent out yesterday. So let me get that out. And it was a little bit of a rant on banking, money, how we are being turned into slaves, how we are basically, we're allowing them to tell us what to do with our money. And I'm just kind of done with the whole standard practice of money management, standard practice of retirement planning, the basics of put money into a pot and watch the pot. And then somehow miraculously, you're going to have this pot of gold at the end of the rainbow. It's, I've been in this business for 25 years, and obviously I took a little break to really figure out exactly what I really wanted to do. And the messaging and the tip of the spear that I wanted to not throw at everybody, but the tip of the spear that I wanted to drive home about money and personal finance. Because it seems like every law or political decision that is made has an effect, an immediate effect, and then a prolonged effect, and then a generational effect on our money and what it is that we get to do and how we get to enjoy those things. So yesterday's Friday 5 points, and to let you know, I think I just named my company. I've been struggling with naming my company because it just can't be Brandi Jo Newman. That's my brand. That's me, of course. But I've been struggling with, what to name it. And I've gone through all kinds of names like Altus, Altus Financial Planning, Altus Money Management, Altus Wealth. And if you don't know what Altus is, it's basically the peak after you go through the valley. All kinds of things. Prosperity. I've got some friends that have a company named Prosperity Economics. All of these different things. But I think I'm going to name it 5 points because there are 5 points within our life, and I'm holding my hand up like a 5. There's faith, family, friends, finance, and fitness. And of course, that fitness has to do with health. Fitness has to do with longevity. Faith. If you're subscribed to my Friday 5 points, you'll understand that I've been proselytizing a little bit and pontificating on the work and discovering yourself and searching for the self and all of that kind of stuff. Family is a given. That's why we're all here. That's why we're all working so hard for our families and to make them proud and to secure them right here, right now, and also secure their future. Finance, obviously, that's a given. Faith, family, finance. Now I've forgotten it. It just went because I just skipped over a bullet point. Faith, family, finance, friends. Oh my God, friends. And that's what I want to start with this morning. Claudia asked me the other day, she says, so alcohol free in 2023 really isn't going on anymore, is it? And I said, no. And the thing about it is, and this is no excuse, but what I found through the 60 some odd days of absolutely no alcohol in my system was complete clarity. And really what it was is that I saw what I wanted to see. I had some beers with some buddies on Saturday, March 4th, I believe. 6, 7. Yes, March 4th. I had a glass of wine with a very new friend of mine in just outside of Kearns, Texas, on the way back home. And then I thoroughly enjoyed myself on my birthday. And then I had margaritas on Sunday. So basically that is the alcohol that I've had. And I had an old fashioned last week in LA with some colleagues. So that is all the alcohol I've had this year. My new friend, that's the tiny home lady, I'll just say her name, Kelly Walker. She's amazing. Didn't take me long to figure out that she is our people. And what she was saying was, it says in the Bible, God doesn't want you to get drunk. He doesn't say he doesn't want you to drink. So I haven't been drunk yet. But again, no excuse. Alcohol free in 2023 is hit and miss, to say the least. And now that I am done with alcohol free in 2023, Claudia has partaken in the Diet Coke. She gave up Diet Coke for me. So I walked in the other day and she's got a Diet Coke, and I was like, hey, and she's like, you're no longer alcohol free. I finally get to drink a Diet Coke. So good for that. My friends, I have the best group of friends right now. And, some come and go, some are always there, some are, just a text away. And they are direct, straightforward, honest, genuine, and authentic with me. And I hope I give that back to them, because those are the things that I strive to be every single solitary day, and live with intention, live intentionally, and live with a purpose. This kind of, my colleague called it a media frenzy, and it's because he has a different way of marketing his business than I do. And I like all of this media. I like sharing my stories and myself with everybody. But the outpouring of love that I received for my birthday was incredible. Just everybody sharing stories with me, everybody sharing how they love me being in their life. And, for everyone who reached out and let me know, sent me cards, sent me presents, gifts, that donated on my behalf, donated certain charities in my name. I truly, truly appreciate you. And it is from the bottom of my heart that I thank you so much for that. And that is not just my birthday. That's every day. I've got a core group I've got a good posse. I've got a really good posse. And I'm glad that they're on my side, because I don't think you want to mess with these people. All right, so let's get to yesterday's Friday 5 points. In the intro, you always want to give some sort of glory to the fact that we're all still here. Now, granted, times are tumultuous, and we have no certainty on what the future will be. We never really do, but we usually have a pretty good idea if we're following our own process. The gist of yesterday's Friday 5 points was this baking mayhem that has become the new narrative. Although there's a new narrative this morning with Donald Trump supposedly going to be arrested on Tuesday. But this narrative this week, in the last 10 days, of banks failing. And here's the thing, banks fail every day. There is always a bank that is going under custodianship, or that is basically being closed down or being sold to a bigger bank. This happens every day. The interesting part of Silicon Valley Bank and Signature Bank out of New York is that these banks were so specialized that they really couldn't act like a real bank. And I know that my money's safe and secure in Bank of America, Chase, and Frost. I know that my money, when I go to get it, is there, but I also know that the capital, the worth, the bottom line of the bank is solidified by the business that my banks are in. The problem with those banks is that they weren't in the business of lending money, because the companies that they supported and that they loaned money to was basically for payroll. It was basically to keep these startups running while they developed either their brand or their platform or whatever. They were the banks, specifically Silicon Valley Bank, and I believe First Republic and Signature Bank. First Republic was given about $30 billion by major banks this week. The gist of all of that is that they were not allowed to basically use that money because those were cash deposits. Those were not long-term savings instruments that they could leverage. And if you know anything about banking and the Federal Reserve System and the fiat currency that we use, for every dollar that we put into a bank in a long-term savings product, a CD, an annuity, but that's with life insurance, a CD, long-term savings, anything like that, they're allowed to lend out 10 times that dollar. So think about this. Think about how you go and buy a mortgage. And I'm going to use the top end, a conventional mortgage, which is usually 20% down. So you have good credit and you go find a house, and we're going to use simple numbers, $100,000. I don't think there's a house in San Antonio that we would move in today that's less than $100,000 on the market. But let's just, for sake of ease and round numbers, let's just use $100,000. You put 20% down on that $100,000 home. That's $20,000. So 20% down, $20,000, and you give it to the bank, and the bank is going to hold it on their asset column. So there is two columns. There's assets and there are liabilities. So you have put $20,000 in the bank, and you have put $80,000 on their liability column, with the security of that $80,000 being the home that you're about to start living in. Here's the thing. That $20,000 just turned into $200,000 in loans to other people throughout your community. Like that. So they're able, with that specific type of savings and that particular type of leverage, they're able to lend out $200,000, because for every dollar that is put into the bank in a long-term savings product, which a mortgage is a long-term savings product, they are able to lend out 10 times that dollar. That's the way that our fractional reserve system works. There's some people like me that are out there saying, oh my God, they should teach this in school. Well, I did learn this in school. I remember learning this in, I believe it was the 7th grade at Maud Laird Middle School in Kilgore, Texas. And they were teaching us fractional reserve banking. And we had this little mock banking center in this class. And I want to say the class was called occupational learning or something like that. It was a great class. You learned all types of little business things. I still remember that lady's face and what she looked like, but I cannot remember her name. Anyway, so I learned about the fractional reserve banking system in the 7th grade. But here's the thing. Banks are allowed to lend out 10 times for every dollar that is put up at the bank. So my $20,000 that went to buy, and I'm using my hand over here, that $20,000 that I put up into the bank to secure my new $100,000 home is now being used by the bank in other homes, in other businesses. And so those other people that are taking out mortgages and those other people that are building businesses, see how it starts to layer and see how you start to get a flow of money. That's an economic system. That is the way America works. Now, I'm not saying I'm a fan of fractional reserve banking. I think we should go back to the gold standard. And I think for every dollar that we have, we should be able to go back to the bank and have that equivalent given to us back in gold. But that is neither here nor there. I don't think there's any way of going back. Although there are some people in my industry that they believe that that can happen. I'm not there yet. I'm not quite there yet. So with that $20,000 that just turned into $200,000, that just turned into investing in other businesses, investing in people's homes, then you start to get this payback system and you start to see how the flow works. Meanwhile, that $80,000 is on the liability column, and that is also tied to the home. The 2008 credit crisis, financial crisis that we endured, people were lending money on homes that were not worth what they say they were worth. And in the case of Silicon Valley Bank, and in the case of Signature Bank in New York, and in the case of First Republic, they are lending money to startups that they are valuing at some wacko level. Okay, so my business. So I have a digital marketing business. I have a financial planning, financial services, retirement business, whatever you want to call it. Claudia has a personal training business. I'm in the private lending business. I'm in the consulting business and the business coaching business. Okay, so that's 6 businesses. So if you put them all under one umbrella, they're worth money. Now, are they worth any money in hard assets? The digital marketing business is, because that is a cash flowing business. The other businesses are dependent upon me. They're dependent upon Claudia. My financial planning, financial services business, retirement income planning business, whatever you want to call it, which I think we should just call it 5 points. When that business generates cash flow, it's not particularly tied to me. It's particularly tied to the clientele. So that's a book of business, and that book of business flows money into and out of certain products and certain vehicles that they need in order to retire and to create and make money and to become more wealthy every single solitary day. Those businesses have a value. So if I go to Frost Bank and I say, I've got a great business. So our umbrella of businesses, which is 7671 Enterprises, by the way. So 7671 Enterprises owns all of these businesses. We just work there. So the businesses are not ours. It is in an entity that we call 7671 Enterprises, LLC. If I go to Frost Bank and I say, I need $100,000 to increase my business across the board throughout all of these other businesses, they're going to say, what are you going to give us as collateral? Home, car, office building, land, mineral rights, timber, cash flow notes, private notes, all of those things are real. Those are hard. But Silicon Valley Bank was saying to their startups that knocked on the teller window and said, hey, we need some money for payroll. Well, what's your business worth? I don't know, $1 million? Okay, well, we'll give you $800,000 against your $1 million business. When they didn't have a business. They didn't have now it was real and they might have had some hard assets, but the problem with the Silicon Valley Bank, Signature Bank, and First Republic is that they're valuing these businesses at such a high level. That's why you see these valuations go up. That's why you see stock prices go up, because someone believes that they are worth more than they are right now. And so they're pushing the valuations into the hemisphere, into the atmosphere, into the stratosphere, hemisphere. They're pushing these valuations up so they can make their books look good. Well, we've got an asset that's $1 million. Well, is it really worth $1 million? You're just saying that it's worth $1 million and you're writing that down on the document. That's all that is. There's nothing that says that the business is worth $1 million or $10 million, $20 million. Then on top of that, you've got Peter Thiel, of all people, that basically sends an email, a mass email to all of the companies that he's involved with. And he has a private equity fund. He has an incubator fund. He has all of these different companies. He sends out this mass email and says, you need to start pulling your money out of Silicon Valley Bank. And he had $50 million in there. So in the afternoon, in about 90 minutes, $42 billion was withdrawn. $42 billion was withdrawn from Silicon Valley Bank. You will go under. You will go away unless a bigger bank steps in and says, we'll take on your crappy loans, your crappy balance sheet. No one did that. And I think the deadline is today or tomorrow. And no one has really bid. First Republic was bid and they were given $30 billion by some major banks, the big investment banks. So think about that. If a big ass bank is not going to go in and buy Silicon Valley Bank, that shows you how worthless they were. And I'll give you one more. This narrative going around about ESG, which is environmental something, anyway, it's some woke climate change, whatever. The San Francisco Federal Reserve Bank. Okay. In the Federal Reserve System, there are 10 banks around the country, and they are responsible for a region. And in that region, they are responsible not for managing the banks, but for making sure that these banks are doing what they're supposed to be doing. San Francisco Federal Reserve Bank, and that is point number 1. And I'll actually share the link to the Friday 5 points. So here's what I wrote. The issue is not the fact that these companies had all their eggs in one basket and the bank's balance sheet was off kilter with horrible performing assets. The biggest issue is that the board was more focused on climate change. Yes, the board of Silicon Valley Bank and the San Francisco Federal Reserve Bank was more focused on a woke agenda of climate change. I believe in climate change. I believe that climates change and that they are cyclical. And it is no different than when God said there should be light. That is what is happening. And somehow these woke ass people want to convince us that somehow it's our fault, because isn't it always the white people's problem? We created the problem. And so therefore they're going to start taxing us, and therefore they're going to start putting upon us the responsibility of fixing it when there's nothing to fix with climate change. Hold on. I go on. I say, yeah, that's right. Climate change. So what I've done, I just simply, and not that you can see this, you can see it on YouTube actually. So here, I'm going to share my screen. There we go. So this is the direct link to the Google search on San Francisco Fed climate change. So that's what I searched on Google in the first one. Why climate risk matters to us, San Francisco Fed. Virtual seminar on climate economics. Okay. Climate change risk economic research. Virtual seminar on climate economics. There's another one. They have one of these seminars every single solitary month. Climate risk and equity in community development. There's that word again, equity. Climate change is a source of financial risk. Climate change in the Federal Reserve. What we learned about climate risk and affordable housing. Understanding climate risk. What we learned from CDFIs. I don't know what that is. The rising cost of climate change. Evidence from the bond market. Okay, So let's dig into the whole climate change thing. I may go on like freaking Rush Limbaugh here for the morning. Let's get into the climate change thing. I'm sitting here in San Antonio, Texas. Last week I was in LA. It's the same fucking weather. It's the exact same fucking weather. Hello, Tosh. Good morning to you, my friend. It's the exact same weather as in LA as in San Antonio. Yes, sometimes we have 2-day winters in San Antonio, and sometimes we have a month-long winter in San Antonio. Climate change changes. It is the same thing going on for centuries. On LinkedIn this morning, there was an article that was posted that said the North Pole is warming to a level that is depleting the polar ice cap. That article was from 1923, and then the meteorologist or the weather scientist or whatever he was, I read it and I can't find it now. He said, this happens on a cyclical basis. There is nothing to worry about. But isn't it funny how people can take a topic and turn it around and make it somebody's fault? And that's what's happening in this entire political climate, our legal system, our political system, and it's getting into our money. Climate change is somehow affecting our monetary policies, because San Francisco Fed, they're one of the 10 banks that sets monetary policy. That's just crazy woke ass shit, people. It is. All right, so I'll post that. Okay, let's get on to point number 2. So point number 2 is, are we scared yet? So here's the thing. I don't think we should be scared. I think we should be properly positioned. And if you have experienced what happened in the .com boom and bust, the aftermath of 9/11, the 2008 financial crisis, the coming 2023 recession. Okay, so you can take those 3 things in my lifetime. And I also experienced Black Monday in 1987. I think I was in 7th grade, 8th grade. Anyway, Black Monday 1987. I remember experiencing that. And that is where basically all hell breaks loose and valuations of companies go to the floor and stock prices become super, super cheap. And what happens with that? It's not that people, hold on. It's not that the majority of the stockholders are selling. It's that the prices are coming down. And so then you see the prices come down, and then you see these massive amounts of investment bank and institutional money, and that's a term I want you to write down. Institutional money come in and swoop up all of these stocks, all these tickers, and then they get control of these companies. And then what do? They're controlling us through what? Our retirement income plans, our IRAs, our 401ks. I'm sitting here right now and I'm telling you that if you were in an IRA or a 401k, maxing that out, what you're doing is that you're participating in a government program. Because what are they doing for you? They are not making you pay taxes on that money right now. They're going to make you pay taxes on that money later. When what? When you don't know what the tax rate is going to be. Let's just take a poll real quick. Are tax rates going to go up or are they going to come down? Are we going to pay more in income taxes later on, or are we going to pay less in income taxes? And here's the thing. It's not only that the rate is going to go up, but the tax base is going to broaden. We're going to be paying taxes on more things. Here's the other thing. The CARES Act, the Secure Act, the Secure 2.0 Act, some of the Trump tax, I can't remember what his tax things was. I can't remember the name of that. But the weakening of Dodd-Frank within the Trump tax changes, all of those things go away. They start going away in 2026. Then all they do is revert back. So right now, required minimum distributions, which is the amount of money that you must take out of your retirement accounts in order to pay taxes, because that's what they do. They say, okay, you can defer, you cannot pay tax until later on. And then when you actually start to take it out, you're going to pay ordinary income tax. You're not paying capital gains. That's the thing. And that's what I have seen so many people just fall into, because it's a generational culture question. Prior to 1955, literally everybody who worked their ass off for 40 to 60 hours a week, they had a pension. They had a guaranteed stream of money when they wanted to retire, and they could retire at 62. And they had a guaranteed stream of money until they were dead. And if they checked the right box, they had a guaranteed stream of money until their spouse died. Think about that. It was a true pension. It was a true guarantee. Slowly, from World War II to 1984, I believe, pensions went away. Now, I have a pension. I have two pensions, actually. And those were in the late 90s, early 2000s, until they phased them out. And they don't give pensions anymore. And it was I would tell people it was a true pension. And basically it was, the companies that I worked for, they were going to match my production in a percentage. So if I produced $100,000 a year, they were going to put 1% into the pension fund for me. And then that 1% compounded over time. And the more production that I gave, oh, wait a minute, I think I'm still sharing. Let's stop the share. So the more money that I gave, the more production I had, the more I worked, the more I produced for the company, that 1% would go in, and it would also compound. And it actually had a guaranteed rate of 4.5%. It is very similar to a whole life insurance policy. And that's the thing that most pensions were backed with in those days. They were backed with whole life insurance policies. As soon as you went to work, there was a life insurance policy taken out on you, that the pension was the beneficiary. Now, the pension is owned by all of the people that have put money into the pension or that have worked for the company. So it is a pool of a lot of money tied to a lot of lives with a lot of compounding going on. And it was glorious. And for the life of me, I really can't think of why they did away with it, except for the fact that somebody wasn't making enough money. And then you had investment banks, and then you had mortgage-backed securities come along. If you will watch The Big Short, there's 3 movies I need for you to watch. Well, there's 3 shows I need for you to watch. The Big Short, Boomer Dilemma, and The Age of Easy Money. Those are 3 things that I need for you to watch so you can get up to speed on what it is that's going on with your money. All right. On the point number 2, are we scared yet? I don't think we need to be scared about anything. I think we all need to take a good, hard, solid look at where we are financially within your own personal economy. So, and I asked that question, how is your personal economy? Are you stable, balanced, diversified, and have shored up your own liquidity? Because what made these banks go under was liquidity. They did not have the liquidity to keep their balance sheet, to keep their assets and their liabilities balanced. They were having to buy treasury notes at a loss in order to keep their cash flow going. It's just, you can only prop it up so much until it starts to fail. So what I've done is that I've released my Brandi Jo Financial Quarterly. And I think now I am actually going to call it the 5 Points Financial Quarterly. I'm going to put this in YouTube. That's in YouTube. Hold on. Let's do this. Let's put this in YouTube. Um, Friday. There we go. Friday 5 points email. And I can't really go in and start typing and doing all of this on Instagram and Facebook. So if you'll pop over to YouTube, you'll see me live over there. All you have to do is search Brandi Jo Newman and I will come up. In the financial quarterly, I go through everything. Now, this is what I want to read. This is my intro. It's about a minute read. Okay, so for the last 25 years, I've built a financial services firm that helps individuals, families, and businesses realize more income, less taxes, and exponential gains on their capital. In my experience and my clients, you must have the triple crown of wealth: protection, savings, and growth. Protection should transfer risk and loss away from your personal economy and replace precious capital. Savings should be a guarantee within your holistic financial plan, with ample liquidity to take advantage of opportunities. This downturn in the market, I believe, is an opportunity. Would I go balls to the wall, all in, and start buying cheap stocks? No. Savings should be a guarantee within, opportunities and growth should expand your choices beyond Wall Street, with a focus on cash flow, income, legacy, wealth. Think about that. Think about not when you graduate, but as you are growing your own wealth, that you're helping the next generation at the same time. This quarter's newsletter focuses on the questions we all have about the future of finance and growth under this administration. Typically, not scientifically, the third year of a presidency is the best year. In a recent conversation with James DeLilio, he is a PhD at Pepperdine, and he focuses on efficient tax withdrawal structures. He teaches that at Pepperdine. You can find him at etfmathguy.com. He mentions his most recent article on the presidential cycle and the markets. From his website, according to a researcher at Charles Schwab, using data from 1933 to 1915, the S&P 500 had average returns in the first, second, third, and fourth years of a presidential cycle, of which 6.7%, 5.8%, 16.3%, which is the third year of a presidential term, and then 6.7% respectively. That's 16.3 average return in the third year of a presidential cycle. That is significant. 2023 is the third year of the Biden administration. Are we going to get there? I'm not quite sure on that. Now, I know what you could be thinking. We can't lose any more than last year, right? Last year's loss across the board was a negative 22%, with only two tried and true asset classes. So we're going to get into asset classes online in my courses. If you don't know what an asset class is, real estate is an asset class, stocks are an asset class, but within the stock market, there are different asset classes. I believe that you should have different asset classes within your entire personal economy, not just within your investment portfolio. These tried and true asset classes beating Wall Street. So they beat the markets across the board. They beat the S&P, they beat the Qs, they beat the Dow, they beat the Amex, they beat everything. And these two asset classes are broadly defined commodities and cash. Commodities and cash are your boring, everyday, run-of-the-mill things that we rely on the most. Think about that. So what's going on? Cash has not been king for at least a generation. So Ray Dalio spoke a few weeks ago about how cash is not trash anymore. It is not trash anymore. Here's my take. My take on cash is that it needs to be correlated to an underlying real asset that creates income and cash flow. You just don't want to take your cash and sit it and watch and see if it grows. You've got to start putting it to work. You've got to get your money into the flow of the economy. So when you invest in your 401k, are you investing in cash flow? No, you're putting it into a bucket and you're sitting there and you're watching the bucket. That's not my type of investing. Okay. This is why I focus on businesses and real estate. Stop picking or index funds is not my thing for my long-term financial targets. It's not that I don't own them. It's not that I don't have them. It supplements. So those things that I do have within those certain parameters, it supplements my long-term growth. But here's the thing. You must fill most of the boxes. So I use an economic model. I'm going to see if I can pull that up, and I don't know why I don't have it up. Excuse me. Actually go here. All right. It's a live show, people, so have some patience. Yeah. Okay, so here is our, of course, now I can't get to me. There we go. All right, so here are the boxes that I continuously talk about. As you can see, now, not all of these boxes are filled, but this particular, and this is a sample client, this is not a real person. All of the purple boxes are usually filled with something. The savings boxes, that's where you are saving liquidity. I don't agree with the tax deferred and the tax free and the tax deductible boxes being in this particular model, because this is where your cash value is held down here. This is the protection box. I'm sorry, this is the savings box, and this is S7. That's how we categorize these boxes: S7, S8, and S9. And then down here is your growth. This is where your stocks, your businesses, your bonds. This is where these slow moving cash flowing assets should lie, not up here in your savings. So when I talk about the boxes, so just like what I said, you must fill most of the boxes. So that proprietary economic modeling that I use, we want to determine how much risk you're going to take on. We're going to determine what is your risk to reward, and then the tax efficiency. The incredible conversation that I had with James DeLilio the other day was so enlightening, because he actually has the real data on Roth conversions. Converting money that you have in your retirement accounts and actually paying the taxes on them now. Because when a PhD from Pepperdine is telling you the tax rates are going to go up, I would listen. So do you want to have less money later, or do you want to have more money later? I can guarantee you that you're going to have more money later if you start to convert some of these accounts. And it's called a simple Roth conversion. Just whoever it is, call your guy and say, I want to talk about Roth conversions. See what they say. And here's the last paragraph. I'm sorry, second to last paragraph. Financial planning is not an either or choice. I think you can have it all. I think you can have both. If you're teetering between choosing to forego taxes, which is to pay taxes later, I don't think you should do that. Now, that is an either or choice, but I think that you can have it all. And I think that you can have the use of your money now. And that's why I call it that it's not an either or choice. You don't have to separate yourself from your money. And that's what I go on to say. We can have all the things with appropriate positioning and weighting They need to be weighted properly between protection, savings, and the growth components. Many hardworking Americans, this is the point that I really want to make. Many hardworking Americans separate a portion of their income in a government-sponsored tax-deferred retirement plan and have come out just fine on the other side of toiling for their trouble. They've come out just fine. I say that everybody can join in the glory of capitalism outside of Wall Street with less risk and more reward to enjoy more gains, more liquidity, more actual money, and take advantage of opportunities in the many different markets available beyond Wall Street. We're not just talking about stock picking and index and mutual funds. Now, in the entire newsletter, there are 8 pages. There's a precious metals report. I am getting big into precious metals. If you saw my TikTok the other day, guns, gold, and don't forget the ammo. But there are more than just gold, more than just precious metals that are gold. There's rhodium. Hello, good morning. There's rhodium, there's palladium, there's platinum. There are other things. There's nickel, silver. Some people are buying silver, and my expert in precious metals is not a big believer in hoarding silver. The all out kind of redheaded stepchild that is, let's stop the share. Let's go back to Brandi. There we go. The all out assault on silver over the years has caused the price to, be something between $20 and $30 in the last, 10 to 15 years or so. Is silver a good store of value? At $20 to $30, it's an ounce. It's affordable. But when we're talking about precious metals today, I don't see the end of the world coming. I don't see, and I admire these people, I don't see the prepper mentality and the prepper mindset being at the forefront of what we need to do with precious metals at this time. I don't really think silver should be, and according to my guy, and I'm going to interview him, and we're going to talk about precious metals. Silver is something that you should keep in case the world does come to an end. But in order to create value and create wealth and create cash flow, gold, platinum, palladium, you want to be able to get in and out of those, and you want to not stockpile them, but you want to be able to own them. And if you do own physical gold, don't put it in the bank. Do not put it in a safety deposit box. And any money that is in a bank, it's really not yours. They could just like what happened to Silicon Valley Bank. Don't put anything that you treasure most in a safety deposit box. Just don't, because the levels that you have to go through to acquire that, you can't get to it on the weekend, right? So if you need it on a Sunday, you can't get to it. But that's the thing. Don't separate yourself so far from your wealth the way that you're doing it. And I shouldn't say you, but the way that most Americans are doing it, they're separating themselves from their wealth, and it's very hard to get out. And when you want it all out at the same time, all that's going to happen is that you're going to pay a big chunk of money in taxes or fees or penalties or whatever the hell. So think about those things. So all of this is to make sure that we're doing everything that we can with our money. So here's point number 3, a transfer to value. Here's the thing with value. The definition of value is skewed these days, with more people valuing what they already own instead of understanding that their value is defined from someone else's perception of that value. So if you really need to sell your home and you need to get out and you need the equity, or you need the capital gains, or you need the money out of that, or you just got to go and you've got to go someplace else, you're going to sell to the quickest, highest bidder, right? And we have seen the days on the market in the San Antonio area go from like 14 days to 70 days. So people are holding on, trying to hold on to that value as long as they can. But that has also to do with interest rates and also people qualifying for the mortgages to acquire those homes. So when you're talking about value, I really want you to think about what someone else is going to give you for it. And so that's when we get into precious metals and those kinds of things, is that the exchange of that value for something else. In as it stands right now with the current situation in the markets, all we're trying to do is be properly positioned to not take so big of a hit and to have the most amount of money later on. That's essentially what it is that we're trying to do. So that value that you're going to exchange needs to come back to you in some other form of value. So what are we exchanging our retirement accounts for? We're exchanging that for income later on. Do you know what your income is going to be? Do you know what it needs to be? Do you know what your income, do you know what your income and your spending is right now? That's called a budget. I texted Claudia today. I said, we need to make a budget and stick to it because I need to start practicing what I preach. Knowing how much money is coming in and knowing precisely how much money is going out. That's it. And with my retirement clients, and again, you know, I started in this business about 25 years ago, and it was like attracting like, and I think my oldest client at the time was in their 40s. Well, now they have retired. And so they come to me and they say, okay, Brandi, I'm ready to retire. Okay, how are you going to retire? Well, I need for you to start sending me checks from my big pile of money that you've helped me build. Okay, well, how much are you spending a month on in retirement? Now, here's the BS factor with this retirement income advisors that I run into. They say that you're going to be in a lower income tax bracket when you retire. I don't see that happening. I see every one of us being in a higher income tax bracket when we retire. When am I going to retire? Probably at 70, because they're probably going to push Social Security age back up to 70. Not back up, but they're going to start pushing the retirement age from 62 to 64, 64 to 67, and then 67 to 70. By the time that I get 70, I will get my Social Security, and it probably won't be any more guaranteed than the next 10 years. Social Security is due to be completely and totally depleted in 2034. That's 11 years. Bankrupt. No more money. So think about that. They have to change something really in the next 5 to 7 years. Is the Biden administration going to do it? I don't see them doing anything. I don't see them taking money away from people because they're big. They give away money all the time, and they just basically say that, you know, we're all going to pay for it later in taxes. But think about that. Somebody comes to me and they say, okay, Brandi, I need to start taking money for my retirement. So they have clicked the retirement box. They no longer have a regular paycheck from an employer. Now the money that they have saved up in these big piles and these big buckets and these big accounts and these big businesses, how do they start getting it out? And how do you get the most amount of money out and pay the less tax, the least amount of tax? And that's what I'm for. That's what I do. And that's why we use an economic model. So when you can see everything moving and flowing through your personal economy, you can actually get a very, very good feeling and good picture of what your retirement is going to be. And I think it all starts with the boring, mundane of a budget. And let's just not call it a budget. Let's call it a cash flow worksheet. Okay? So we're just going to see our cash flow. Right now, probably, well, the last person that retired with me, they were making a little over $255,000 a year. And that was from businesses. So that money was taxed at the least amount of tax rates. It was mostly capital gains. So they have life insurance, they have annuities, they've got money in index funds. And then they also have what's called, let's just call them investments in other businesses. And so those businesses cash flow. And then they get an income. Most of my clients are not in a 401k. The 401k as a whole is great up to the match. But most of my business owners, they came to me with either a single member 401k or a SEP IRA. And I showed them, look, you can do it this way, or you can do it this way, or you can do it this way. And what I would show them was the good, better, best plan. And they would always choose the best plan. And the best plan had nothing to do with any government sponsored tax deferral accounts. And those are the ones that they would choose, because we would put it side by side and we would put it on the model. And I would say, do you want this, this, or this? Well, I want that. I'm making the most amount of money and I'm paying less in taxes. Okay, this is how you need to be properly positioned. It's pretty damn simple when you see it on one sheet of paper. And then you can take the different scenarios and say, well, I'm making the least amount of money and paying the most amount of taxes. Now, in all of these scenarios, in the best plan, I'm making the least amount of money, because the least amount of money to me means that more money has gone to my client. That's the glory. That's the essential part of my job. My job is to make my clients the most amount of money with the less amount of risk, with the least amount of risk, and to pay as little tax as possible. Period. End of story. All right. Point number 4, I promoted Bill Noble. He actually found me online and I started teaching him golf about 2 years ago. And he is a character. He's got a YouTube channel that has thousands of followers and thousands of views. And in the email, I actually promote him and tout his YouTube channel. I'm going to interview him for the Brandi Jo show later in the season on Roku TV on Your America Network. So that's Bill. And point number 5, and I mentioned this documentary earlier, The Age of Easy Money. And in point number 5, I say, we knew we would be right here. We knew that this liquidity crisis was going to happen. We knew it. So here's what I write. I'm an East Texas economist. My roots in the oil fields, tall pines, and playing in the conference rooms of banks with my Uncle Jack gave me a real education in money and finance. Here's the thing. Easy money, which means that you just go to a bank and they say, here you go, which is what happened to Silicon Valley Bank. It will cost you 100 times more money later. Easy money is bad money. So my background in education is through the Austrian School of Economics. I am a Mises follower. I am not a Keynesian. I am a true capitalist when it comes to our economy. So in this, I write, I have read enough of the books they don't want us to read to know they want to make us all slaves. So think about that. The more money that they promise you, the more you will give to them. The best book that I've read based on Austrian economics is The Pension Idea. And it is a 55-page book, and it is available for free. I'm going to put this on YouTube. Here we go. So The Pension Idea is it's a small little book, and it's free. I just posted it. It basically teaches you why the pension idea went away. It totally went away. And I think I have like 22 seconds left on Instagram. So I'll wrap this up pretty quick. What I want you to do this weekend, I want you to watch The Age of Easy Money on Frontline. You can find it on YouTube. When I post this on this channel, you'll be able to click on the link and go straight to the documentary. I don't know how long I've been going for, probably over an hour. I could go for days. I want to thank you. Bye. Oh, that's funny. All right. So still on Facebook. I'm going to post on Instagram real quick. If I can't move my crap out of the way. Still on YouTube here. Oh God, don't fuck it up. There we go. All right. So if we're all still here, here's the difference, but here's the biggest issue in the wealth gap that's going on right now. More Americans than ever, their job is their only source of wealth. Okay. These hardworking people that make America great don't have 401ks or own stock. They will starve if they lose their job or jobs. Most of them have multiple, and then they will be a slave to the government. What do you think happened during COVID? Where do you think all these food servers and kitchen workers, where do you think they went to? They're subsisting on government help, and they have lessened their ambition. They have no incentive because they're not going to starve. They have a roof over their head. And I just don't think that that is true capitalism. So if you can, go to YouTube and just Google the age of easy money, because that's how we got right here, right now. I am going to post this on Instagram. All right. So, hopefully we're going to keep doing this every Saturday, and then we're going to get more questions. So here's the other thing. If you're still watching, and this is actually going to be available, I'll upload it to YouTube. It will stay live. It will stay living on Facebook. It will stay living on Instagram. I will take little snippets from this, and then I will post. I will do little reels with it as well. Any questions? Always reach out to me. You are my support, and I want you to know that I just want to help. And if you ever need help, I will help you. I will explain things in a way that will make you feel better about your current financial situation. The biggest thing is that the biggest issue that I see is that you go to your HR department, you click the box on your 401k, and therefore you think that your retirement is all done. And you just work hard, and then they give you a little bit of a match. That's going to be the ultimate downfall. We're going to see an incredible recession this year, and we're going to see people lose their jobs, and we're going to see people hurt, and we're going to see people not be able to survive in the current economic climate. And that's all I have to say about that. All right. I want to thank everybody for being here with me today. And there was some nice people getting there on Facebook, and absolutely no one on YouTube. So we're going to end it now, and hopefully we'll see you next